So what we've got here, ladies and gentlemen, these are alternate assets in front of you. They can go long and short, and they like to go both ways. So that's the reason today that we're having the good. You can take that whichever way you want. We're having the good, the bad and the ugly because they love good and they love ugly even more. So in the 1960s, Sergio Leone's spaghetti western, The Good, the Bad, the Ugly, the good was Clint Eastwood, the bad was Lee Van Cleef, and the ugly was Eli Wallach. Now, which one of you want to be the good? Who wants to be Clint Eastwood?
I'm happy to go first.
Well, we're not going to force you to be ugly. We're going to give you a chance to be good, bad and ugly. So what we'll do is we'll try and cover all three topics and everyone have a bit of a chat on each one. So the good, we'll start with you, Phil, since you're a bit chirpy over there. What's good about the market at the moment? We're about maybe 1, 2, 3% range of all-time highs that we hit back at the end of July. What's good in this market? Low interest rates, high valuations? Off you go.
We think growth is good. We think we're in a growth-starved world. We're in a low-growth, low-interest rate environment. If you can find a company that has organic growth, it's like finding a nugget of gold. It's like watching the Wallabies beat the All Blacks. It doesn't happen as much as it used to, but it's very rewarding when it does happen. And so we're on the lookout for growth companies. Equity returns come from two sources. They come from EPS growth and they come from re-ratings. And at the moment, there's not much EPS growth out there in the world. But when you find a company that has good EPS growth, you often get the re-rating as well. And so you get that double banger effect.
Phil, can I ask you there, given it's a low growth world, what qualifies as good growth these days?
Oh, look.
In terms of EPS earnings growth over a period.
Obviously, you have to look at the risk as well as the return, Matthew.
But is it lower than it used to be?
You know, if you can find anything with double-digit growth, that's very, very attractive. I think, probably the market used to grow at an average of 8 to 10% EPS growth. I think the market's, many top 10 stocks in Australia are lucky to be growing at all. The banks will be lucky to grow in the next 10 years. Many other companies in Australia in the top 10 or 20 stocks are not growing. But we've had over 40 stocks in our portfolios, and we own a lot of stocks, mind you, double this year. And that's because, when stocks do have growth, the market really rewards them. And so stocks like Zip, which is going to be, I think, probably one of the 2 or 3 survivors in the buy now, pay later space, is up 3 times. A stock, we own ISX, I sign this, which helps people identify themselves, is up 10 times. And so the market gets very excited when it sees something that has good growth. And
if we go to the big end of town, we've seen stocks like CSL, Cochlear, they're growing not at 20-odd% a year, but they're growing high single digits, maybe 10 if you're lucky, but they're getting these enormous ratings. You see that continuing, that kind of, with the bigger, more liquid stocks?
Yeah, look, for a big liquid stock that's reasonably reliable, if you can get 8% growth, that's great. And I think that's a very good result. I think the problem with a lot of the companies that do have growth is that, and I'm erring onto the bad, is that a lot of these companies get very highly valued. And so we're trying to identify the growth stocks before other people discover them, and we're trying to buy them before the market discovers them, before they go in the index, and in some cases before they IPO. Because once the rest of the market discovers it, there's such a scarcity of growth. A lot of these growth companies start trading on huge multiples. And I think part of the bad there is the fact that there's so many passive investors in the market, they push these stocks up. And a lot of the growth companies in Australia are what I call 1/3 owned by founders, 1/3 owned by growth managers, and both growth managers and founders don't usually sell if the stock goes up. And so if the index funds and the quant investors come in and buy another third of the company, there's no natural selling, and these stocks can keep going up. And the problem with the passive funds is that the more the stock goes up, the more they want to buy.
Don't get too excited about the bad yet, because we'll come back to that. Ben, you we're deep into a cycle, and you very much focus on accounting and how the numbers are presented to the public. I mean, that's all we get twice a year here and 4 times elsewhere in the world. So what at this point in the cycle, where growth has slowed and there's a lot of pressure from investors, what would you look for as good, as something that you, on a stock level, that you rate?
Yeah, well, our business is a lot about avoiding the blow-ups. We actually go looking for those on the short side to protect our investors' capital, and we actively look for red flags. So the good for us is finding the companies that don't have those red flags, and our sort of source of truth for our research process is the financial statements. And just looking at how companies present those financial statements, whether they're conservative about the presentation of those statements or aggressive in the way that they account for things. And what we mean by conservative is taking things as expenses and depressing your profits rather than capitalising them and putting them on the balance sheet, which inflates your profits. There's a lot of companies that we're seeing in markets these days that are taking a lot of costs as one-offs below the line and focusing the market towards underlying profits rather than reported profits. So we like companies that are conservative about the way they present their accounts. It indicates to us that management aren't having to stretch or pull levers to really maintain a multiple or a growth rate that the market's been expecting. A good example of that is our largest stock, Smart Group, which has been a consistent deliverer of, I suppose they've been under-promising and over-delivering for a number of years. It's a very cash-generative business. The cash that it spits out is always quite close to its net profit. That they expense everything that they can, and there's a good deal of management and board skin in the game.
Okay, let's just stick with an example like Smart Group for a second. So Smart Group came onto the boards 6, 7 years ago. High growth company, very small, grew into $1 billion stock. Growth has slowed, and its multiple was compressed up until recently. There must be a temptation to try and eke out that growth for longer. So is it about the messaging to investors? Because we heard earlier about how investors want so much for growth. Is it about getting people in line rather than trying to do something to your numbers, do something to your expenses?
I think when you can find a good cash generative company with a great industry structure and the market gives you an opportunity to get that company on sale, like we had on Smart Group, earlier in the year, you've got to jump at it with both hands. So the rise of passive investing does give you opportunities when stocks get disconnected from fundamentals on the upside, and occasionally you'll get a chance to buy a good one, on a dip. So we're on the lookout for those opportunities, but yeah, having to report monthly numbers, you're just always looking for that chance to buy a good quality company on a dip.
Okay, Anthony, another thing that happens deep into a cycle is that certain multiples get big. It means you've got great ammunition to go and buy other assets, maybe in your field. You might diversify a bit. Allocation of capital is crucial in this period because when things turn down, it come back to bite you. Do you want to talk a little bit about how important it is at this point in the cycle? Any time, but especially now?
Absolutely. Look, I think there's a massive temptation for companies just to go buy back stock or roll up using their massive multiple to go and buy, make things EPS accretive. You got this PE magic where you just go, you're on a 50 PE, you buy things for 5 PE. All of a sudden, you've made a 20% EPS accretive acquisition, and you're not really adding any value. But that's something which we've seen, and we're seeing more and more of. The other thing which companies are doing is they're just wanting to get the EPS growth in the short term and buying back stock. Having said that, I do. So
that's about allocation of capital as well.
Not always. I mean, buybacks can be good if it's a good way to return capital to shareholders. But if I look in the US at the moment, they've gone nuts on the whole buybacks. And what happens is it's great in the short term. Management get their STI targets in the short term. The share price generally goes up, but for a rainy day, you want to have a good balance sheet. And a lot of activists come on registers. They say, listen, go buy back stock, sell, lease back that asset, et cetera, et cetera. And it's good for the short term. But I think when you've got a downward cycle, you want to have a strong balance sheet. And an example of that is I look at the car retailing. We as a value investor, we don't have 40 stocks which have doubled, unfortunately, in the last little while. We generally feel that growth is, obviously Phil's absolutely right, and he's been bang on, but
he was showing off a bit before.
Yeah, I know. No, but he's bang on more recently. But I feel like everyone talks about value traps. There are growth traps as well. I mean, when you've got we talked about WiseTech before. It's $350 million worth of revenue and a $12 billion market cap. I mean, we're going... So people have just lost their minds in some of these things completely. But I think what we like looking for, we're not scared to go to things with a few hairs. Not scared to go where companies are cyclical. And I look at the car retailing. APE is a very good operator. You've had Nick Pilates, 35% shareholder. The board owns sort of another 5% of the industry. They didn't buy back shares. They didn't do sale and leasebacks. They waited. And the low end of the cycle, they got a bigger competitor to theirs, Auto Holdings, and they've done a merger for equals. And that's that. They wouldn't have been able to do that if they bought back stock at the peak. You had 15 months of a declining new car sales. It's really tough out there for most people out there, but they use their balance sheet and they use their script to go in and swoop in and buy Auto Holdings at zero premium. And I believe that they're a substantially better operator. And so they're going to, and you can see that 10 years ago, Auto Holdings had double the EPS of AP Eagers. Now it's the other way around. Yep. The dividends were about the same 10 years ago. They're now double from AP Eagers. So we feel that, well, I feel that operationally there's a lot they can do. They've got their sales are about 30% below, but their earnings are about 20% higher. So I feel there's massive operational improvement, and
it'll set them up for years.
Set them up for, yeah, absolutely.
Yeah, Nick's pretty good at getting his man, and in this case, he got his company.
He got his company, and him and Martin. Martin's one of the most energetic CEOs I've ever met, and he'll continue to find operational improvements. I'm not saying, I mean, the stock's, it is one that's actually doubled for me. It's not saying it's cheap here.
No, but it's had a great rally, yeah.
But I think they've set up now for the next 3 to 5 years, yeah.
All right, enough of the Clint Eastwood. Now we've got to get ugly. So we're Lee Van Cleef for the moment. Phil, we'll go back to you. You touched on it before. The good is anything with growth, as you said, is gold. But there's an ugly side to that because there is enormous valuations. Anthony just touched on it. I don't know whether WiseTech fits into that bill for you, but there are enormous valuations compared to what most people in the audience and us are used to historically.
Yeah, no, exactly, and I agree with Anthony. WiseTech's on a huge valuation. It's a great company, but $12 billion is a big number. And that's one of the big risks in the world, I think, is the valuation on some of the stocks out there. And as I said before, I think a lot of this is getting fueled by passive investing. And, we've heard a lot about the death of active management and how passive investors are outperforming. But my strong view is that this goes through cycles. And the passive investors are winning. And as they win, more money flows in. And that means they win more. And so that's why we're seeing stocks like WiseTech and some of the other expensive growth stocks go up so much, because the index buyers are buying more and more. But when this bubble pops, I think it's going to be very positive for active managers, and especially active managers who can short. And that's where, the three of us will really outperform, is in a bear market. And I think that'll provide great opportunities for long-short managers.
So let's go back to your example before with Zip, which is a growth stock, reasonably big valuation for how old it is as a company. Assume we go through that bear market and the tech, especially the tech side, does have a meltdown. What happens to a stock like Zip, or does that provide an opportunity to go long? How do you see that? How do you play that?
Look, a bear market, all stocks go down, and that's a growth stock, and it won't do well in a bear market. But part of our thesis, as I said, is to discover these gems before other people discover them. And so it was announced last week that Zip is going into the ASX 300, and so there'll be a lot of people buying, passive investors buying next week as we're selling. And so, we'll use things like that as an opportunity to let some go. I often liken it to the example of, being a hunter. The passive investors, they're like animals, they have to come to the waterhole twice a day, and we just lie in the bushes and wait for them to come and just pick them off when they come. So, yeah, I don't want to...
And just to finish off on that, do you think we will have a meaningful correction? Because there's been a few blips in the last 18 months, 2 years. There's been volatility return to the market. But the companies who do project growth, whether they're expensive or not, have really rallied hard off any dip. Do we see a genuine bear market in some of these stocks or not? Or is that...
I don't see a bear market on the near-term horizon. I'm talking later about the outlook on the market, and I don't want to steal my thunder. But I don't see...
Okay, we'll leave it there.
A bear market on the near-term horizon.
Okay, Ben, on your thematic, which is looking at numbers of companies at different points in the cycle, what looks a bit ugly to you? I mean, I think you mentioned it before about companies slowly evolving their reports to investors and changing what they report and how they report it.
Yeah, there's a few of those in the bad, I think, that are getting are really dressing up their accounts. They've used things like buybacks to inflate share prices, often to get sponsor partners like private equity or management out of the stock or founders out of the stock. That's added balance sheet risk to their businesses and made them more vulnerable to a downturn. So I've got a couple of examples in the bad to talk to if we want to. But if we want to get ugly, there are actually some real ugly ducklings in the market these days. And there's a little group of companies that I suppose really try and avoid scrutiny, and we would put them in our bucket of fads, frauds, and failures. And where you see a company that starts to get really aggressive about attacking critics or even people that ask questions about their business model, that is a red rag to a bull for a short seller, and it should
be talking about corporate travel, would you?
I'm not going to go to corporate travel, or there's enough blood being spilled on that one at the moment. But there have been consistent examples over the years. We saw, Quintus. That was an example where the company took an analyst at Taylor Collison to court for a report that was largely factual and got thrown out by the judge as effectively to us looked like a court-approved short thesis.
Yep.
So where you see companies getting very aggressive with either journalists or analysts, excluding them from trips. I mean, we have often dial into conference calls for companies, and when you hit *1 to answer a question, some of the dodgy ones won't let you ask a question, and that makes you look further. So there's a little group. They're not a big group. They are getting found out, but they're always there in markets.
Can I wind you back a bit? You're starting to get ugly there.
That's pretty ugly.
Yeah. Let's go back to bad. I don't know how much no short positions are going outside the room. Well, that's the deal today with the journalists and everyone else, hopefully. But just the evolution of companies slowly changing their numbers, because there is a lot of pressure to hit growth numbers. It's not necessarily something that's a fraud. It's not that extreme, but there are companies over time that gradually do different things to their numbers to make sure they hit certain growth numbers. Can you give us some examples around that?
Yeah, look, there's a few. I think Ingham's is a good example of one where some of the chickens are coming home to roost.
Boom, boom.
Anthony's got a few puns for later, so I thought I'd jump in. Look, that was a private equity sell down. You've had a business that has had assets sold out of it and sale and leasebacks to boost returns, which means it's more vulnerable to a downturn at some point. They've used stock buybacks to push up the share price, which has also allowed the sponsors to sell out. And you've had the CEO and CFO that the company IPO'd with have also exited and sold stock. So when you combine that with cash flows that have been boosted by things like factoring of not just receivables but payables, you've got a company that is probably more risky than the profit and loss looked at in isolation would suggest. So, yeah, that's the kind of thing I would put in the bad, or not ugly, but certainly it's been dressed up and in the avoid category.
And that occasion, bad is good, I gather, for people who are able to short, given recent history. Anthony, you're a bit the same on what you consider bad. Yep. You're always worried about how companies report, because that's all we really get at the cold hard light of day. Yeah. Is a couple of times a year we get the numbers. You got any examples of what you would look for that you rate as bad, not necessarily ugly, but things that the warning lights are going off?
Yeah, absolutely. Look, we're a bit old-fashioned, and we look at NPAT, profit after tax, and you pay, because that's what you can pay dividends out of, right? And then we used to get a little bit funny when people talk about normalised NPAT, which just takes out some of the one-offs, etc. Now people are talking at EBITDA. And EBITDA is obviously, I mean, before some very important costs, including depreciation being the most being capital expenditure or a derivation of that. Then you're getting normalised, and now it's become common for normalised EBITDA to be stock-based compensation. Stock doesn't exist. It's sort of like, we're going to pay our staff through stock, but that's not really a cost
When
for
you've
us.
got rolling STIs and LTIs.
Absolutely. And then now it's actually gone up the P&L to sales. And in fact, what we're seeing more and more of is, don't worry about sales for this year. Our 2025 forecast in sales is X, but it's not a forecast. It's not a forecast, it's an aspirational target.
But we'll give you a number anyway.
And we're going to give a slide in the presentation which has our market cap today and our sales and how it's gone, and look what our sales are, what will our market cap be, sort of thing. So, yeah, as we get further and further up that P&L, and we're starting to see that, you've got to get more and more sceptical about what's going on. But just going back, the one thing we do look for is sustainability of earnings, and you look for companies which, it's one thing to have look obviously the difference between cash and earnings and how they've arrived to the number. I always get suspicious of companies which always just meet or beat their target.
Right.
And I mean, GE is a good example. They did that for 14 years, and then you see what happened since. You know, and so any company which actually which basically runs the business on that quarterly earnings is something you got to watch out for. And one which we have been short in the UK is I know the litigation funding space quite well. Burford's been the biggest in the world, and they're unlike the Australian counterparties. They use fair value accounting just like Slater and Gordon did. And there's nothing wrong with using fair value accounting. It just inflates the earnings. You bring earnings from the future to today. Yep. And there's nothing wrong, but it's just like a drug. It's an addiction. They keep on revaluing cases which have yet to be won. And once you start doing that, the cheerleaders from the fund managers, etc., say, listen, I want you to beat next earnings, they'll do more and more. Yep. And then, I mean, lucky for me, there was a short thesis, a short seller came out with a report, and the stock fell 40%. So you're starting, I mean, that's the sort of stuff I like looking for. Okay, now we can get excited. The ugly. Go back to you, Phil. What's potential to be ugly in this market? You talked about growth is gold.
I think there's more value traps than I've seen ever before. Any company that's reliant on the economy to provide earnings growth is going to struggle because the economy is quite soft. And so we've seen, I think, a record number of downgrades this year, the greatest number since the GFC. We've seen a lot of downgrades by stocks that look cheap, stocks like Boral and Bluescope and Brambles, and there's a long list, Link. And so I think it's dangerous if you're just trying to buy value stocks, because often the value that you think is there is not there. And the economic cycle, a lot of those stocks people buy for the recovery, whether it be in housing, whether it be in auto sales, we talked a bit about earlier, for the recovery down the track. Given how low growth is the cycle not what it used to be, and those companies will be left hanging out there? Growth is anemic, and it's hard to see when growth will get stronger. It's the flip side of a low interest rate environment. Interest rates are low because growth is low, and they will go up together. And, I don't think they're going to go up in a hurry. So I think investors have to get used to this low growth environment we're in, and they should position their portfolios accordingly. And I guess the other area that we see a lot of value traps is what we call old media, old retail. The world's changing. A lot of these stocks, I think, are traps. And where do the great, well, not great, but large infrastructure stocks fit into that? You like growth. You be wary of value traps. There's been a big re-rate for these bond proxies in this low growth environment. Where do you put those in? Because they're not high growth. They're pretty low, but they're bond proxies. You pay a premium for growth, but you also pay a premium in this environment for earning certainty. And I think, Transurban and Sydney Airport and some of those other infrastructure stocks did look quite expensive, but bond yields in Australia have halved over the last 12 months or so, and those infrastructure stocks haven't really responded. And so I don't think they're quite as expensive as they used to be. Okay. Ben, you wandered into the ugly section earlier. So what goes from bad to ugly? What are the real... You talked about companies that are very defensive. Can you elaborate a bit more on that and maybe give us an example over time and how it worked out?
There's a few. Our most successful shorts over the years have been the ones that are hugely reliant on external funding to survive or to grow.
Like fund managers.
The fund managers, they shouldn't need external funding to grow. If you're performing and growing assets,
Well, you all need customers.
you all need customers, but you shouldn't have to be asking, equity or debt markets for money constantly. And that was the red flag for us on Blue Sky. But so what you can see, a combination of stretched balance sheets and problematic business model, that's where you get, the chance of really outsized returns. And we've seen that recently with stocks like Speedcast in our market, where, those passive investors perhaps aren't spending as much time on balance sheets and cash flows as they should. So it can create opportunities. And whilst they can be painful and tick up on you, very slowly, if you happen to be short those stocks, you can get those big asymmetric returns from something like a Speedcast. But the really interesting one on the ugly side for us, early in the fund's life was a little stock called Buccaneer Energy, which is the pirate company, and there was a group of Americans that came to Australia to raise money and wanted to develop oil and gas assets in Alaska. So that's an expensive place to do business, and they flew a bunch of analysts up to Alaska, including us, for free to see the assets. And they didn't do it once, they did it twice, which gave you an opportunity to see how little progress there was actually on the ground in Alaska. And we were handed wet weather gear and warm gear, and they immediately started spending shareholders' money like it was confetti. And the company logo was a pirate ship with a Latin insignia around the outside that the CEO would wear. And in the airport, I finally got up the courage to say, what does the Latin insignia mean? And he said, it's Latin for take the money and run. And so, needless to say, that was a good short. And
that was a good opportunity to lie.
Yeah. So companies that can be too transparent as the opposite of the ones that are. I would avoid those. The ones that need money constantly, there has to be a pathway to generating some cash. Sure. So if you can't see that pathway, you can get in real trouble.
Okay, Anthony, there is a flip side to what Phil's saying about very low interest rates, very low growth, especially for the financial services sector. Interest rates in Australia could go to zero at the official rates at the short end. We're not that far away. What's the repercussions of that for the financial sector in particular?
Yeah, look, it's going to be, as we all know in this room, I guess, the financial service sector is pretty tough. And I think, you look at... One thing I look at is, on top of that, when it comes to shorting, Ben and I do... we share some similar sort of thoughts about some of the shorts. But one thing I do look at in a lot of detail is, and very poorly analysed, is what the competitive environment's going to be in 3 to 5 years in any industry. And I typically believe that capital flows towards the hottest sectors, and so you really need to be very confident that competition is not going to go, because analysts don't really look at margins just going bottom left to top right. I look at the financial services space. Those platform companies, I think it's going to be hard. It's going to be hard stock on a couple of fronts. One is you're going to get increasing competition on those platform fees. And the second is, as you mentioned, is as low interest rates are lower, the ability to get that cash spread is going to be harder. And I do believe that more and more people are looking at these things. When interest rates were much higher, it was sort of not as front of mind. But getting the cash spread on interest for a lot of these platforms is, I think, for a lot of the more mature ones, has already gone. For some of the new ones, is going to go. So
there's been a gold rush there, right? The big institutions have been leaking money at 1 million miles an hour.
Absolutely.
And their funds under management the independents have rocketed.
They've done a really good job. They're good platforms, etc. But they're not bagging the companies. They're good companies. And look, you look at the AMPs and the IWFs. They're again, they look cosmetically cheap, right? But they've got a lot of headwinds. But you look at them, the net wealths and the hubs. Again, they. I wouldn't say they look cheap. Net wealth, I think, is the value play. It's 56 PE. I think Hub's the 100 PE. But I feel that you've got massive headwinds associated with the platform fees, spreads, and the fact that I think the strong stock market, in my opinion, has hidden a lot of issues. And look, fund managers fall into that bracket as well. I think it's you look at Pendle, etc. And there's another one. It's hard, and so I just feel that financial services space in a low interest rate environment is probably tougher.
Okay, I think we're going to go for some questions, guys. Is that Tom? Did you want to do, or we keep talking up here? Keep going. Okay. All right. Let's now, because we've got about 4 or 5 minutes, which is perfect for this section. It's the thing that we always should do. I said before, we're 3 or 4% away from the top of where Australia's been, where the US has been. Some markets around the world, a bit less than that, 5-10% off their highs. And we've got a low growth, we've got trade wars, we've got a lot of things going on. We've had an inverted yield curve in the US, which has spooked people. We've had Chinese currency devaluation, which spooked people for 2 days. We've got a pretty jittery market. Do you want to just, over the next 12 months, each say, how do you think the market unfolds? Do we go, I don't want a percentage, I want a direction. Do we go up?
I think the market grinds higher. We're in a low interest rate, low growth environment. You're not going to get the returns that you're used to. But, I think relative to the bubble that's perhaps developing in bonds, I think equities are very cheap.
Yeah, Ben, I know you're very much a stock-specific person, and you'd be happy for the market to go up or down, I gather.
We don't really mind, but look, internally at Totus, the more time, we joke about the more time we spend on macro, the less money we make. So I can see the bull and the bear case. It's been a theme here, but stocks, it's been a good run. Interest rates at zero are not a cure-all for the business cycle, is my simple take, because otherwise we'd have great performing stock markets in Japan and Europe. They'd be the world's best performing stock markets, and low interest rates can be bad for the banks, and that's the lifeblood, the plumbing for the economy. So I just think you don't want to be limit long. You want to have a bet each way, and
here's another thing for you. Given your portfolio, do you see more opportunities on the short side or the long side?
There is a chance we are running, approaching a golden age of short selling. I mean, the stocks that we talked about before, the Ubers, the Lyfts, the WeWorks, that have not just got question marks about whether there's a path to profitability. They've got long track records of loss making. So you actually have data to analyse on these businesses, and they've already created good opportunities for shorts and ways to protect your capital if we do have a broader downturn. So I'm optimistic about active management over the next decade. Absolutely.
Anthony, I thought you were agreeing there, but you're rocking your head backwards and forwards.
No, I was just thinking about WeWork. I mean, just a stroke of a pen, it's gone from 40 billion to 20 billion valuation, and that's and it may not even come. I mean,
this is about to float.
It's about to float, and
they've had to halve the valuation to get it away.
But that's what can happen. This is what can happen. I mean, there is a false market. I believe in growth stocks. There's a massive, again, I go back to the 12 billion. I mean, for just a stroke of a pen, for a valuation to go from 40 to 20 and then maybe even lower. This is a business model, I believe, which is not sustainable. You lease out. I know Servcorp. I've been investing in and out of Servcorp for 10 years.
You might have been the analyst back then, were you?
Yeah, I was, yeah. But you lease long term and you and short term, you got your lessees short term. So
it's a mismatch.
In a downturn, and your typical clients, I mean, what happens is your clients are great for a while, but once the whole sitting on bean bags and having beers, etc., wears out, people want to be serious at work. You want to actually be able to have, and so you got the lowest quality of customers. You've got startups, young startups, etc.
You're obviously showing your age there.
No, sorry.
The beanbag culture could last a long time.
I was just shaking my head, but I think I could name probably in the top 200. I'm not waiting right now. Stocks which will fall 90% and still be expensive. They're probably about 15, 20.
So from that comment, I'm guessing you're on the same side as Ben. You think we could be in a good age for
I don't know
shorting.
I actually don't know what his conclusion was.
He said, to quote him, you said we were approaching a golden age of shorting.
No, I'm probably a little bit, but I think we're probably lower than 12 months from now. Yes, and I completely agree. There are more shorts are more excited about my short portfolio than the longs. There's some good ideas.
Yep.
But there's some, and I think the opportunity on the long side is stuff which other people aren't looking at, if anything with a few hairs, no one wants to touch.
Yep.
And I think that there is a path. If you can find a path to things turning around, well, there's some good opportunities. But yeah, I agree with Ben. There's more good ideas on the short side, and I think the market will be lower in 12 months' time.
The active management might rise from the dead.
Yeah.
Anyway, gentlemen, thank you very much. I'd like everyone to thank Phil, Ben and Anthony for the discussion on the good, the bad and the ugly.